We're here to look at 3 stocks that just hit their 52-week low. We're going to analyze them, see, is there a reason for it, or should we be paying attention now because they've become cheap? First one, VMware. Broadcom, it just came out that Broadcom wants to buy VMware for $60 billion. Isn't for sure yet, but that is the announcement from some inside sources. Something I want to show you guys that I found interesting. Back in 2003, EMC buys VMware for $635 million. 1% of what they're being sold for today, 19 years later. Isn't that just neat to see? That's what I like about it. I just want to show you guys that. So let's go check out VMware on our 8-pillar software. Boom, VMware. So some highlighted. So look at this. This is the big jump from the announcement. Why? Because the company is currently a $48 billion company, and the announcement's for $60 billion, which is a 25% premium from today. Some of the major attributes here. 5-year PE is under 20. 5-year profit margin of 23%. Last year's only 14%. First off, I'm sitting there going like, wait a second. Why is the 5-year average and last year's number so different? No dividends being paid, but pretty stable cash flow, it seems. So right now, at $4 billion in free cash flow, they're basically buying for $60 billion, 15-to-1 price of free cash flow. Okay, not bad. And a high return on invested capital of 16.4%. That's pretty good for a company like this. But look at this. 52-week high of 167 is the share price. 52-week high of 167. It's now 116 after getting as low as $93. So here's the 8 pillars in the company. They've increased their shares outstanding just slightly over the last 5 years, and they have a little bit more debt. Now, with a company like this, it's software, very, very high gross margin of 82%. So for every dollar they add to their revenue, they're adding 80 cents basically to their bottom, to their profit. So they can probably sustain a little bit higher debt than most companies. So the question becomes, guys, is this an arbitrage play like the deal for Activision that Microsoft has that Warren Buffett's currently invested in? Can you buy this company if you're banking on Broadcom buying them and then wait for the jump to $60 billion market value, a 25% increase? Well, before you do that, I encourage you to make sure you want the company if it doesn't happen at the current price. So let's go to the stock analyzer tool, where we can use assumptions about the future to determine, is this a reasonable price to pay for the company? So, stock analyzer tool, let me expand it just a little bit so you can see it a lot easier. Guys, if you have our software, jump into it right now. It's easy to follow along. It makes it a lot more fun and exciting to do, and put your own numbers in as you're doing it. So, revenue growth. Guys, my goal is to be conservative. I'm going to go 4, 7, and 10. Profit margin. I'm going to ignore last year because that just looked like a fluke year, especially considering free cash flow was pretty close to the previous years. So I'm going to do 20, 21.5, and 23%. Free cash flow, I'm going to do 31, 32.5, and 34. PE, 14, 16, 18. Same with the price of free cash flow. And like always, a 12.5% return. Hit the analyze button. The company's currently at $116. This is looking pretty interesting, guys. We have a lot of green here. A lot of green. So before the big jump up in price, it was selling for, we only had one price below our assumptions. So guys, what I would say here is, based on what I'm seeing, this looks very interesting. I'm going to do more research to determine, hey, maybe I want this company either way. And the plus side is if it gets bought out by Broadcom, I get to buy out a 25% premium to my price. So that could be the play here. And that's what makes investing so interesting. Guys, another company at a 52-week low, Eaton Corporation. Shout out to Eaton, located just 20 minutes up the road here in Beechwood, Ohio. Absolutely gorgeous headquarters. Remember that thing was going up. I was like, that thing is freaking sweet. So let's pull up our 8 pillars software. Again, guys, if you have the software, just pull it up, go along with me. So another one, 52-week low, 130, selling there. 52-week high, 175. So a couple of key metrics here. They have a little bit slightly higher profit margin last year than the 5-year average. A little bit pricey on the PE, but pretty consistent with their 5-year average. Their dividends are a big chunk of their cash flow, especially last year's cash flow of $1.37 billion. They paid out $1.24 billion. I like that number lower than 50%. Even based on the 5-year average, it's a big chunk. So, and not a huge return on invested capital. So let's check out their 8 pillars tab just to make it easy. Ooh, Cleveland not representing here right now. A lot of X's, guys. High PE, high price of free cash flow, lower return on invested capital, decreased revenue, decreased net income, decreased cash flow. Guys, does this mean you ignore it? No. If a company's cheap enough, You should be fine buying it. If I told you a company was going to have $5 of profit, then 4, 3, 2, 1, and go to zero, it's still worth something if there's no debt or anything like that. That's one extreme. Somewhere in the middle of the extremes, there's a reasonable price to pay. So our job is to look at the company and say, okay, what do we think? Now, this is where I might deviate a little bit and look at analyst expectations. I don't really like looking at analyst expectations a ton, but they can be very intimately involved with the company and get guidance from the company. So let's go look at their revenue growth numbers for the next, look at this. So this is the next, 8 years? So it's around 5% a year, okay? Nothing huge, nothing big, but it's already a big company. They sell a lot of electrical equipment stuff, I think. I mean, I don't really know exactly what they do. They're just based in Cleveland, in Beechwood, Ohio. So it's around 5% a year. All right, let's look at their earnings per share. Earnings per share going up a little bit faster. Why? Buying back shares. So look at this. They're looking at double-digit earnings per share growth in the next 5 years. Okay, not bad. So let's, like we did before, let's go to our stock analyzer tool. Let's figure out what we want to pay for this company based on our assumptions from today using a 10-year analysis. Now, revenue growth numbers. Look at the 1 year and look at the 10-year and the 1 year revenue growth numbers. I'm going to err on the side of the 10-year number. I'm going to go with 0, 1.5, and 3%. Profit margin, I'm going to go with 10, 10.5, and 11. Free cash flow margin, I'm going to do 9.5, 10, and 10.5. PE, big company, not a lot of growth. I'm going to do 13, 15, and 17 for PE and price to free cash flow. And I'm going to do my 12.5% return to give me my ample margin of safety for such a large corporation. Hit the analyze button. Remember, guys, the stock's at 131. Oh boy, it's got to fall and fall hard. So it's at mid 40s on the low side, 70 on the high side, mid to high 50s on the middle side. Now, remember, guys, you might sit there and think that's too low, but look at these numbers. This is not a high growth company, so you have to be very conservative on your assumptions. So if I'm interested in the stock at 60, I might hit a plus mark at 58 and just change this to 60 and hit notify me. All right, so now I'm going to be notified by the software when I get these numbers and go, okay, maybe it's time to take a closer look at it. For those of you who think that might not happen, look at history. It very easily could happen. Just look what's happened in the last 4 or 5 months in the market. Guys, our final company at a 52-week low, John Deere, ticker symbol DE. So let's go back to our homepage. Again, if you're following along at home, John Deere. Look at this price drop from 438 just a month ago to a low of 309 and current price of 334. Guys, these things happen. That's a 25% drop from peak to bottom in this last 1 year that happened in the last 1 month. These things do happen. A couple key attributes for John Deere. 5-year profit margin around 9.6. Last year was 13. So I'd be apprehensive about applying this profit margin throughout. Dividends, oh boy. Guys, they're paying out 90% of their free cash flow in dividends. I do not like that. That just drives me, and it's not even a big dividend yield. It's only 1.2%. And a 5-year return on invested capital of 2.4%. Guys, I already feel with myself, I got to get a huge discount in this company because I don't like that. It's a $100 billion company. Let's go to the 8 pillars tab. Oh boy. How the heck are they even buying back shares when they pay out all that money in dividends? I don't even get it. Oh my God. Price to free cash flow, 70. Oh boy. Oh boy. This is not good, guys. I mean, revenue growth, net income growth, and cash flow growth, but this is just ugly. I want to go check out their income statement directly. Let's click this on. Oh yeah, big jump from last year. A company that did basically the same revenue for 9 years, all of a sudden had a huge jump. Profit, again, big jumps. I don't like that. That just tells me it's going to go back. It's going to be stabilized. Look at this revenue growth. The revenue growth is only 2.1% a year for the last 10 years because of last year. So I'm actually being very conservative here, guys. I'm going to go -2, 0, and 2% revenue growth. Paul, -2, they're not going to decline. Maybe they won't. Maybe they will. But John Deere is a very cyclical business as well. I'm just apprehensive about that. I'm going to be very conservative on these numbers. Profit margin, 8.5, 9, 9.5. Guys, whenever I see free cash flow and profit margin being this far apart, I immediately go, wait a second, what is going on here? How can a big company like this have such difference in free cash flow and earnings? They should be very similar over long periods of time. Look at these numbers differences of the last 10 years. 1/3. That's odd to me. That alone makes me go, I'll find better. But if you really insist on doing this, I'll show you how our stock analyzer software can really help out with this. So free cash flow, 3, 3.25, and 3.5. PE, 13, 15, 7. Actually, I'm going to go 10, 12, 14, because there's so much uncertainty. I don't know what's happening here. And I'm going to go 15% return, guys. Yeah, look at this. Because of free cash flow being such a small percentage, look how low those numbers are. So if you want to focus on earnings, you're between 82 and 135. It's got to drop 60% from here. I'm probably wrong, but guys, the whole point here is when it doesn't make sense to me, I in my head move on. Thanks very much, everyone.